Welcome back to Investment Banking University's Front Office Investment Banking Process course. We're now talking about the deal structuring process. Go to investmentbankingu.com and register right now. We're going to start off by talking about the table of contents, which is going to discuss the front office investment banking process like we do with every presentation. And then we're going to go into why deal structuring, the deal structuring process, valuation range, and deal terms. So just to start us out like we always do, the front office investment banking process starts out with coverage, goes into mandate target matching, origination, fee structuring and winning the mandate, underwriting, packaging, buyer list creation, deal structuring where we are now, and the M&A process. So why deal structuring? So after matching a financial or strategic buyer's mandate with the target and landing the M&A engagement, and building and executing on a buyer list, it's important for the investment banker to work with the specific buyer and seller to structure a deal. This is going to include at a high level evaluation range and then diving into some of the more pertinent deal terms, which is what we're going to be talking about right now. So in terms of the deal structuring process, just at a high level, we're talking about getting into a valuation range where a deal can actually happen, and then ultimately negotiating the deal terms consistent with the seller's wants and the buyer's wants. So in terms of evaluation range, I've shared some data points here for the SMB lower middle market going into the middle market, and I'm going to touch on those in a moment. But first, deal structures initially have a rough valuation or range of valuation to make sure that both parties are in the sphere of reasonability. Reasonable deals look like in the SMB and lower middle market going into the middle market, 4x for under $1 million of EBITDA, 5x for about $1 million of EBITDA, and then upwards from there from the $1 million to $2 million market above $2 million. And basically what's happening is as the company gets larger in terms of their cash flow, which is EBITDA is a proxy for cash flow, the demand for those businesses is increased very much so in a very large proportion, and that's why we see the multiple increase. So in terms of the deal terms, what we're really talking about is understanding whether this is going to be an asset sale or a stock sale, and if the compensation is going to be cash or stock or cash and stock. And then we need to understand, is this going to be a majority or a minority ownership deal? And we'll talk about some of the implications there. And then ultimately, whether the owner plans on staying on as the CEO or the management after the transaction, or whether there is an existing management in place. Next, we're going to be talking about owner financing if it's available in some capacity. That can often happen in the SMB and lower middle market. And then ultimately earnouts. Are we going to be tying the performance of the company to the actual exit terms and the compensation that the seller is going to receive? So these are some of the points of negotiation with regard to an actual M&A sale. And so the M&A advisor or the investment banker is really going to need to dive deep and get an understanding of what this is ultimately structured as so that he or she can communicate that to the strategic and financial buyers. So what we've talked about today is in fact the deal structuring process, just at a high level, talking about the valuation range, deal terms, and how that fits into the overall front office investment banking process. So go to investmentbankingu.com, register for the course, and this is Investment Banking University's front office investment banking process course. Thanks for your time.